Hey guys, welcome to another episode of 21st Capital. Today we're going to look at Bitcoin crash. It was a pretty sizable crash, leaving a lot of people in panic. We're going to talk about the causes from macroeconomics perspective and from the on-chain data and derivatives perspective. We're going to look at what's going on and what has happened and how much damage it has caused and what are the root causes of this market reaction. Today is Friday, February 28th, and I have Crypto Wizard, lead researcher at Glassnode. Hi, Wizard. How are you?
Hello. How are you doing?
Very good, very good. I'm just watching the usual cycle of fear in the market, where as soon as price drops a little bit, people begin putting out analysis that shows Bitcoin is dead and top is in and it's all over and all that. So kind of repetition of what we've seen about 100 times so far. And people never learn the lesson, and psychology always worked the same.
Yes, very interesting market dynamic. It was much expected. I'm not saying we could have predicted 100% it's going to be a crash or a correction, but I mean, it's very well expected that people who are spending now is most likely, as we will show, is the people who bought at the top and now they're caught in a very, very bad situation and they are in the middle of like market crashing. Probably most of them entered the market recently and now they're like puzzled what they should do. Let's see. Let's look at the data, and then we will answer some questions.
Okay, so first things first, we have announced something major. We are about to launch a data analytics platform for Bitcoin, which is basically live charts and consistent content in the written and video format about Bitcoin from all angles, again, including economics developments, which really impact Bitcoin, liquidity, global trade, and so on, and also on-chain and derivatives perspective, essentially looking at every piece of relevant data that we can find for Bitcoin. So we're going to put out reports, weekly reports and videos, and I encourage you to follow that. So let me show what you can check. If you go to 21st Capital waitlist-bi, you would be able to join our waitlist just with a first name and email. Here's also a little video of explaining the service. It's all going to be free. It's all going to be free, and you'll be able to access our platform next week. For now, we are basically spreading the word, and next week it will be fully launched. So join our waitlist. Hundreds of people have joined since we tweeted about it. We look forward to seeing you there as well. Okay, now let's bring us back. Okay, a bunch of things. Bitcoin has crashed quite a bit. This is it's a 27% crash from the top of 109. Depending on, if you measure intraday highs, it was 109. And it's a 27%, 30% crashes have been very common in prior cycles, but because volatility has been so low in this cycle, this actually seems to be pretty strong for what we have seen, the behavior we've seen in this market. Now let's see how bad was the last time this happened. Yeah, okay, so all the correction that we saw last year from the high of ETF approval, which was in March, we reached 73,000. We killed the all-time high, and right after that we began a 7-month correction, and we bottomed 26% lower. And this time, if we consider from the close of 106 We are now down by 22%. So actually looks like a similar magnitude. And today we're going to talk about why this happened. Okay. When you look at the data, first of all, congratulations to Crypto Wizard. Last week we were here, we were talking about the drop in liquidity of Bitcoin, and Wizard was explaining what he did for Glassnode, which was a full report about falling tide of liquidity. So his analysis turned out to be dead on, actually too accurate, unfortunately. And the market has been decimated since then. What's going on? If you ask me, the first reason I'll bring up for this is macroeconomics. Two things are happening. First of all, Trump is dangling these tariffs in front of all the investors. And the way tariffs work essentially is that tariffs are a tax on imports. So essentially, whatever revenue that Trump's administration generate from the tariffs, however many billions of dollars, that's what the importers, U.S. importers, have paid. Essentially, this causes them to import less. This causes the domestic manufacturers to have fewer raw materials. That means raw material becomes more expensive. As you can imagine, you can't quickly switch to another country, right? It's all going to be very painful and difficult to find replacements, and all ends up in higher costs. Higher costs means less production. Less production means a slower GDP. Less products means higher prices and more inflation. Now, we were saying these for the last however many months since Trump got elected. And even before that, when he was proposing the tariff idea, we were mentioning that two things will happen. Economy will crash, inflation will rise. But people were too positive, I guess. A lot of people were saying, oh, in 2018, we didn't have a surge in inflation. So everything that we know about economic theory has been canceled and doesn't apply. But sadly, it didn't. And the moment the market has felt Trump is very serious about these tariffs, markets are crashing. S&P, NASDAQ, they've all dropped. If you just want to look at NASDAQ 100 index, it has dropped quite a lot, peak to trough by 7.5%, and mostly in reaction to tariffs. Another thing that tariffs have caused is that no one knows what's going on. So Trump has proposed a 10% tariff on Canada and Mexico that got paused, and no one knows if it's gonna be reinstated when the time comes next month. Trump just yesterday confirmed that he's very serious about it, and that's right after that the markets began crashing again. Then we have China tariffs. There's already 10% applied, pretty much the only thing that's actually happened. But now Trump is saying, I will do another 10% on China. There's also proposed tariffs on Europe and the reciprocal tariffs to kind of apply reciprocal tariffs to any country that has tariffed the United States. All these are being proposed, and they are on and off. Like you see, like there is delay, there is reinstating, there is more announcement, there is more fight. This brings uncertainty. Uncertainty worries investors and companies. Many of the boardrooms of American companies right now are in panic mode. How are we going to replace all these suppliers from China and Canada and Mexico? A lot of the US economy depends on imports. So they are now, instead of focusing on the actual business, they now have to focus on how to deal with tariffs. Similarly, investors, when they face uncertainty, they simply go to safe haven assets, which is cash, treasuries, possibly gold. On top of that, today we had the Zelensky issues. Zelensky reportedly had a fight with Trump and in the White House, and allegedly he was kicked out of White House. So after reports of that came out, markets began crashing again. And the third factor I'm going to talk about is the inflation. Again, tightly related to all these tariff issues. If you look at month over month CPI, it has been on the rise. Like from last year, May and June, we had a 0 reading. And then since then, 0.1, 0.2, 0.3, 0.4, and 0.5 for January was reported. This is a ton. 0.5, if annualized, means about 6.5% annual inflation. So that's pretty substantial. If we want to stay at the Fed's mandate, which is 2% annual, we should see monthly 0.2 values. But we have had 3 months of rise. This is pretty bad. And exactly when does it really accelerate? In November. What happened in November? Investors realized that tariffs are coming. You can also look at the core PCE, which is Fed's favorite measure. This one is very interesting because it has been showing the same pattern of increase month over month. The latest month over month is 0.3, which if this 0.3 continues, annualized will be 3.6% inflation, which is almost double the 2% that the Fed is looking for. But just because the year over year metric went down from 2.6 to 2.5, everyone is saying, oh, this is a great number and inflation is dealt with. But first of all, it's only PCE, and you see a disastrous move in the actual CPI. Second of all, the more recent value is terrible annualized. So we will see what happens, but it's very clear that inflation is picking up. You can also look at import prices month over month. They are rising 0.1, 0.2, 0.3 for January. And it's not looking great for inflation. Similarly, again, exactly from November, we've been seeing massive rise in Michigan consumer inflation expectation. Inflation expectation is important for economists because if their theory is if consumers expect inflation, they're going to raise the prices and they're going to demand for more wages. So the chances of inflation getting sticky goes up. So we have all these things happening. Tariffs are hurting global economy, global trade is slowing down the trade. And we also don't even know what China and Canada are going to do in retaliation. So it can get significantly worse before it gets better. So global economy is slowing down. Inflation is picking up, which means fewer rate cuts and more selling of the financial assets. All of that means sell-off, crash. And Bitcoin is going to be the first thing that gets crashed. It's a bellwether of the global economy. It's the easiest thing to sell. It's the most liquid asset on earth. So it sells off the fastest. But it also bottoms before everything else. So what do you think about the macro side of things, Zi?
Well, macro, like I'm just a very, very uneducated person when it comes to macro, but just trying to reflect on what I saw from people that I believe in and they talk about macro. When I look at them long term, there's no, especially Leonardo put it really nice, there's nothing to stop this train. I really understand it more and more when I read the numbers. For example, they were talking about the Doge is going to give people $5,000 out of the money they're making by cutting costs. When you look into it, that money that they're promising people is way more than what their dream they're going to save by, I don't know, cutting the government costs. That tells you the politicians are going to print money no matter what. So but if I want to talk about Bitcoin long term, I'm talking about a couple of years from now. It looks like they're not going to stop printing. So it's still, I believe in Bitcoin as an alternative. And when you look at news today, like BlackRock is adding ETF to the Bitcoin ETF to their, I think they call it allocation portfolio. They call it like targeted portfolios, literally a tool that they define for the investors, institutional investors, to play with Bitcoin allocation in their portfolio to meet a predefined risk and return portfolio. If you look at them, you see BlackRock and all these big players, institutional players, are still interested in Bitcoin, and that interest is growing. I mean, 1 to 2% allocation of Bitcoin ETF into their model portfolios. That means what? They have $150 billion, I think, in their targeted allocation portfolios. 1.5%, 2%. That's just the start. So, and who's gonna say that that's it, 1 or 2%? You might go to 5 or 7%. So long term, I don't see anything changing my mind yet. But in terms of like the war that Trump is waging, I mean, in Europe, in the draft wars, I mean, not obviously not the real war, that is creating a lot of uncertainty, and a macro event like the Bybit is a recipe. And also being a top heavy market, as we spoke about it last week, all these three ingredients is a very nice textbook's definition of, hey, be ready, we're going to have some downward in the market. So I don't know, is it coincidence, or we can just speculate, oh, some hidden hands is moving the market somewhere. It looks like it was a very, very bad timing, this Trump war against Europe market, and the buy beats, and also the demand side being already exhausted. These three components actually hand in hand created a very nice driving force to push the market down.
Exactly. Another thing I will add is I've been also, for the last year, I've been developing these valuation models for Bitcoin, trying to understand if we can measure when Bitcoin is undervalued or overvalued, or maybe oversold or undersold, if that's the right word. One of them, if you guys have been following me at all, you know that one of them is the Bitcoin Quantile model. And this basically gives us a potential range of distribution for prices, and then measures the probability of observing each of those regions, and gives us a 0 to 100% quantile value, which we call the risk score. The higher the risk score, essentially, if you're in this region, means the chances of a correction or a crash is a lot. Chances of topping is a lot. If you are in the green or purple region, that means the chances of going up is a lot. Essentially, you can see this gives us something that resembles a channel for price. Now, this quantifies where we are in the overall spectrum of valuation from 0 to 100. At 83,000, that gives us 52%. So we are not even anywhere close to a top in my book. The other thing I will say is it hasn't been difficult to predict what happens. I've been saying that we expect the markets to crash because with tariffs, inflation will go up, markets will slow down, and dollar will rise. DXY is, the last time I checked, it was at 107. And I want to bring this to your attention. Essentially, I was earlier this month, I was like, when tariffs crash the markets, weekends will sell Bitcoin. It's okay. It's time to buy at a discount. I wasn't expecting a 30% crash, but I was expecting some level of crash. It's totally expected. Nothing really new. If you go down to like 40K, then I will begin to think about something different has been happening. But this is totally within the realm of possibility and realm of what we would expect. Let's see if I have another thing to add from this to it. Yeah. And then we can also look at another valuation model that I've developed, which is the VPLI. Essentially, this is another metric that tells us whether we are overheated or cool or in the frozen zone of the market. Again, VPLI puts out at 47, 50 is neutral. So we are still playing around the neutral value, and that's also visible in this chart that puts us this is a power law average trend line that has been doing a fantastic job tracking Bitcoin over the last few years, which is like this one. Like this trend line has been doing a fantastic job going through the mean value for Bitcoin. And right now, if you just look close, we are simply, we've been a little bit overvalued compared to that trend line. And now we are kind of coming back to it and now a little bit below it, exactly like what we saw last year. Overvalued, undervalued, and then finally this line took us back up. Right now we are below, probably spending some time here until market heals itself, and then we continue to move forward. This is what I look at a lot more than the actual price. Right now, this trend line, which I sometimes call the fair value, is kind of like an average price you can expect at this point of the cycle. That's just reached 90K. So this will continue to go up, like everything that Wizard said about BlackRock increasing allocation, all sorts of things that are happening under the surface. I personally know of a bunch of companies that are trying to be the next MicroStrategy. Sovereign wealth funds are buying Bitcoin. All that is happening while the price is crashing. So fundamentals getting stronger, but price don't show these things immediately. It takes some time. Once the damage of this crash is gone, we'll come back up and Bitcoin will continue its growth as this trend would suggest. So if you're new to the market, first of all, don't read too many analysis that people publish at this point is very, very emotional and very negative. If you're gonna read a bunch of people saying, "Oh, we're gonna crash down to 50K or 60K," there's CME gap, this gap, that gap, and it's gonna be much lower. And if that's gonna make you panic sell, hoping that you can buy lower later, that's the recipe that's exactly how a lot of people get hurt during the ups and downs of Bitcoin and get left behind. So beware of not repeating that mistake. One of the best things you can do is just dollar cost average and close the charts. Don't look at the charts too much if it's kind of worrying you a lot. Simply set up a DCA plan so that the lower the price goes, the more Bitcoin you'll buy, and at some point this will come back up. And once we hit 100K again, I'm gonna take this clip from this video and show you that how crazy selling at these prices would sound when we have recovered. Okay. All right, so I've talked too much. I'll let Wizard continue with a look into on-chain data. I had some charts here too. Maybe I'll sprinkle them in during his discussion. But I think next we're going to look at on-chain data and derivatives and see what's going on.
Let's do it. I have to share.
Do you feel like the sentiment is negative?
I was expecting a little bit bounce back actually today, but it didn't happen because it was actually oversold in short time frame. But apparently, retail is really, really, really bearish because I mean we broke down to 78, I think, last night. Yeah. And this morning it went to 86. I was hoping that we have it's just hope. There's no prediction. I was hoping we sustain a little bit here, get the people who were trying to catch the falling knife exhausted, and then crash or correct a little bit further, but it didn't happen. I feel the market is so bearish, and it's also due to the stock market as well. Look at the QQQ ETF. When you look at them, it's negative. Tech sector in general is negative. So it looks like people are de-risking. And if you look at the ETF's outflow, over last week, we had a couple of the largest outflows from BlackRock. I don't know if it was BlackRock or in total. I mean,
the whole thing.
Yeah, the whole thing. We had a really negative outflow. Hey, people are buying ETFs tickers. They're gonna be like me and you. There are a bunch of them might react emotionally, or some of them actually might literally just have a portfolio. Their model is telling them you have to de-risk and spend some Bitcoin. That could be it. Look, they're human being, even though they're called an institution. That doesn't mean they're gonna hold Bitcoin forever. And it played out really, really similar to what people do, selling at top. It was funny, but
Now, if you look
that's
at here, this is another great indication of what you just said about de-risking. When people de-risk, they'll go buy long-term bonds.
yeah,
And this on this yield curve, I have today's curve, which is the blue, and then the red is last week's yield curve. And you see, like the short term really hasn't changed, but long tenure, for example, and basically everything from 2 year onward have been significantly purchased. Like when people buy a lot of bonds, the yield goes down, and you can see like the 10 year yield has gone down pretty significantly. Perhaps the biggest drop is in 3 year, but this is a clear indication that people are transitioning towards bond positioning instead of equity positioning, and that's why everything is selling off.
very interesting. Yep. So first of all, like we just explained, the macro in general was showing some weakness, if I'm right. And like you explained, there was a couple of negative signs in macro was looming, and people felt like there is a risk off. But the main thing I think was the last nail in the coffin of a $1 million Bitcoin by Q2 dream was the Bybit hack. So this week in Chain, thanks to the great team we have on Glassnode, we have a bunch of data that I really like to talk about them. And I think that was one of not the only reason, but one of the catalysts to encourage people to start to risk off and spook the market at a very bad time if you're a bull. First of all, the outflow. I have to actually highlight this. The Bybit hack was, by dollar term, the biggest crypto hack. It is crazy. Like right in 2025, we are having the biggest hack in history of crypto. Right after we were like 109, like in December, and 105, I think, again in January. So it was a very, very bad time. Right at the top, when market is almost seeing a demand side exhaustion, we have this Bybit happening. If you look at the outflow of Ethereum from Bybit wallet, you could see compared to the historical outflows, which is the people settling their, trying to get some money out, like a typical normal daily transaction. If you look at the size of them and compared to the outflow, it was crazy. 403,000 Ethereum outflow in one day. It's just crazy. The amount of Ethereum was extracted from or hacked from Bybit was very enormous. And the CEO explained there was a mask UI. I'm not really technical, but it was like a very, very sophisticated hack that happened. But when you look closer, it was not just Ethereum. Like 400,000 Ethereum was hacked. But when you look at it, they had this ST ETH, stake ETH, 91,000. They had 8,000 M ETH, another stake ETH, and 15,000 CM ETH. So if you put them together, it's around $1.48 billion was hacked from Bybit. And that was crazy. Around 517,000 Ethereum and stake Ethereum was hacked from the cold wallet. And if you here we just broke down, majority of it was the Ethereum itself, and then the rest was just the stake ETH tokens. And I'm showing how significant this drop was. And after that, we saw there was a recovery, which we'll get into, but that hack was crazy. And when you look at the other assets, Bitcoin and USDT, which are the major assets after Ethereum, after we saw that hack, you could see people panicking and extracting their fund from the Bybit. Around 200,020 Bitcoin was on a net basis was withdrawn from Bybit. Around $1.7 billion USDT and around $217 million USDE. So that hack spooked people. This is a great indication of how people or institutional client, people who are putting their money on exchanges, reacted to that news. Like Ethereum was what was hacked, but Bitcoin and USDT was showing some sort of like people who hold them, they were panicking and extracting the money. This is a confirmation of panic in the market that has different consequences. One of them is extracting their fund from centralized exchanges, but also you could imagine that panic is going to be selling. That's another form of showing you're panicking. And if you look at the dollar value, the BTC and the stablecoin outflow on a net basis, it was around 4.3 billion. These are the money that was extracted after the hack. It's not the hack itself, it's just Bitcoin and stablecoin. And the dollar value of Ethereum, like I showed, it was around 1.5 billion. Then they start to do a replenishing, outsourcing Ethereum, buying it, as they put out in a tweet. The CEO put out or retweeted another tweet that was saying they were buying from the OTCs, they're buying from other exchanges, maybe getting some loan. We don't have much clarity or data about that, but we can see they almost uh, recovered or bought or outsourced around $1.2 billion Ethereum, which was close to 1.5. And after that, still we see there's an outflow. It could be the people who were waiting and panicking and trying to get their Ethereum out. And right now we are almost close to what it was before the hack. But this is what actually caught my attention: $4.3 billion Bitcoin. It is fair to say the majority of it is the people who are panicking and extracting their fund. But also, when you look at the outflow inflow to exchanges, you could see something more interesting. This is the Ethereum volume added to Bybit after the hack. After the hack, around $1.5 billion Ethereum was sent to Bybit. This is mostly what they bought or outsourced or loaned, whatever. From that $1.5 billion inflow of Ethereum to the exchange, around 800, more than half, uh, was through 8 or 9 transactions. So it was big chunk of Ethereum coming in. These are the Ethereum they bought. These are the Ethereum they loaned. These are the Ethereum they just outsourced from the third parties or whales or I don't have enough data to just identify who gave them the Ethereum, how they uh, just got that Ethereum. But it was through 8 transactions they received half of that $1.5 billion Ethereum coming to the Bybit. At the same time, you look at the outflow of Bitcoin that we discussed and USDT, more than half of the outflow, because they were selling assets apparently, or they were just, we had a combination of BTC and USDT being used to buy Ethereum, and also some people just literally extracting. If you look at the large transactions of Bitcoin and Ethereum, you could see close to half of the Bitcoin and USDT leaving Bybit was through large transaction. A handful of transaction actually extracted half of the Bitcoin and USDT that was withdrawn out of Bybit. That telling you these are that selling or exchanging or using as a collateral that was happening. So they majorly used USDT and Bitcoin to recover their Ethereum. That is a little bit a sell pressure in the market. That was the little push that we needed to actually um, react to that negative macroeconomy, the negativity due to the demand side exhaustion, then the Bybit, both psychologically and also there was some sell pressure by BTC. They sold BTC to actually outsource that Ethereum. So all these factors, plus the last week's falling liquidity article that we discussed, if you put them all together, you could see, okay, market was already exhausted. Meme coins and Solana, like we explained last week, meme coin and Solana was literally showing a lot of capital outflow. They drained the market. Now Bybit happening, a little bit sell off by possibly a spot sell off BTC to buy the Ethereum. All of them hand in hand just trigger the market crash or market correction. I don't know what
So
term
can
is.
we? So I mean, this seems pretty strong evidence that uh, to cover for the lost ETH, they have sold Bitcoin. So this is kind of also one of the reasons the market is so weak.
You cannot say for 100% sure, but I mean, connect the dots. There was around a couple of $1 billion BTC withdrawn from Bybit through a handful of transactions. So these are not retail. These are not a small whale. It's just literally a big chunk of Bitcoin sent out, and you could see majority of it was sent to other exchanges, and it's happening at the same time. A big chunk of Ethereum coming to the Bybit. So yes, like if someone can dispute this hypothesis, say, hey, what is your evidence? Like we do not have literally the contract or actual evidence to prove that there's been these Bitcoins were exchanged for Ethereum, but I would say this is a pretty strong
But they made
indication.
it very clear that they are getting loans plus some gifts.
Yeah.
And if it's loan, you can imagine they had to put up some collateral.
Exactly. And I think there was this tweet that the CEO retweeted, and he explained it. He almost confirmed what Luke Onchain said. And in this list, you can see loan could be, they speculated, is it the loan or is it the buying, whatever it is. He almost, like OTC buying, he almost confirmed, yes, we are buying Ethereum. As a big chunk of it was like from OTC desk and loan from other liquidity providers. So these buying and loaning, you need, like you said, collateral. You need the currency to pay for it. Most likely with a good, I mean, as I showed, the big transaction happened the same time, and there were like a handful of transactions. It shows BTC was sold to buy this Ethereum, and I'm not saying that's the reason market crashed, but that was one of the significant reasons that actually pushed or encouraged, added to the negative side of the catalyst to push the price down. So I don't want to blame it solely on Bybit. Like I explained before, the Bybit hack happened in the falling liquidity article last we discussed. Market was already in a weak situation. You could see the capital and literally retail was losing enough money on meme coin and Solana that we had enough reason to see a bear market, at least in mid-term. Bybit was literally just a extra push. That's how I call it. And when you look at the crash,
let me show you. Let me show you a little point here about how Ethereum has been doing. It seems like it has raised. This is a chart of Ethereum versus Bitcoin. It seems like it is resuming the downward trend, and it's very interesting to me. This is the whole ETH BTC chart, and it looks like most Ethereum holders are in losses measured in Bitcoin. Like if this is the number now, well, all of the price action from December 2020 up to now is just loss for Ethereum holders. There's a little period from June 2019 up until July 20, where if you had bought Ethereum and held all the way up to 5 years later, you would have been in some profit. Most of the prior cycle also would have been bad for you if you bought Ethereum. Only if you were one of those early adopters that were kind of, heard about it very early on, or you were actually the Ethereum Foundation that holds a lot of supply. Only those guys are in profit versus Bitcoin. Most other people, especially most people buy at the tops, are now at a loss. And this basically confirms what we have been, like when we were at this top point, we were saying that, holding Ethereum is risky, it has more risk, and it doesn't have as much, power behind it to grow. Despite people talking about all those NFTs and monkey JPEGs on the blockchain and so on, but this, our thesis is essentially playing out that long term, it's a very risky bet. And again, recently, after you were saying that after the hack happened, they had to buy some Ethereum from the market, and the hackers have not sold because it's not easy. So Ethereum pumped a little bit, and this prompted people to think, oh, this whole thing is now good for Ethereum and everything is great. But just for the record, I put out a tweet and I said ETH is slightly pumped versus Bitcoin. It's an artificial temporary pump. And I made a prediction. This pump will fizzle out quickly and ETH BTC will resume the downtrend. This was February 22. I'm really I just put out that tweet to come back to it later, and looks like we've now resumed downward trend. So again, that I told you so mug is necessary to have on this show.
Yeah, it's pretty sad, to be honest. Like that Ethereum and L1, I would say, or last cycle altcoin holders, they're suffering. I mean, look at it. We are 80,000 something. The pain in the market is like, it's very similar to post FTX when we were around 17,000, like at the bottom of literally a bear market. Right now, we're not very far from all-time high, but the pain is so much. I think it's mostly because people bet on a wrong horse. By wrong horse, I'm not saying it was predictable to say the right horse was the meme coins on Pump.fun. If you were telling me 2 years ago there's going to be a platform called Pump.fun, people can create a coin and start to absorb some investors in a matter of 24 hours, I wouldn't believe it. I wouldn't believe it. But it turned out to be the unique way to extract capital from the market. I don't want to make it evil. I really believe this meme coin mania was actually needed. Actually, it was in a quick way, people would understand what is shitcoin, why a soft money is going to have a loser, and it's going to be you, because you don't have the edge. You are not the creator, so you're going to always going to be late. But people paid and learned this lesson in a hard way, which makes me sad, because they could literally, instead of just getting involved with all this speculation, they could have spent that money on something more important. I can imagine. But hopefully they get a lesson and they start to invest in themselves and try to increase their income. And if you have extra money, you can use that money by investing in hard assets. And Bitcoin is one of them. I'm not claiming Bitcoin is the only one, but Bitcoin is one of them, and turned out to be popular for many of people around the world. But hopefully that's going to be a lesson. Let's get to the bottom of who's selling. That's a very, I think, valid question. In the recent downturn, if you look at the loss being realized by short-term holder or recent investors, I try to make it a little bit simpler, and long-term holder or the long-term investors, almost 99.99% of the loss realized or the aggressive sell-off in loss was done by the short-term holder. It looks pretty, I mean, simple, but we have to go a little bit deeper and see what do we mean. Short-term holders are people who bought from 1 hour ago to 6 months ago. Who actually was selling? If you look at the breakdown of the realized loss by different age cohorts and only look at the short-term holder, you could see the majority of them is the 1 month to 3 month and 1 week to 1 month. So literally up to 3 months ago, which is the top buyer. They were the one that were selling in this downtrend, at least based on on-chain data. They were selling mostly in loss because their cost basis is above 80 something thousand. And when if you look at the realized price by age, we can prove this, that the reason they were selling in loss with that in that magnitude, realized price by age. Let me look at the short-term holder course. If you look at their cost basis, let me okay, and aggregate it. You could see the cost basis of before the crash, the cost basis of the 1 week, 1 day to 1 week, it was around 96. 1 week to 1 month was 99. 1 month to 3 months was 98. So this was actually mostly that loss realized throughout this market correction was done or was realized by the 1 hour to 3 months ago. These are the top buyers, and it's pretty expected. Like if market started to crash, the new investors who bought at the top are the first one you would have expected to sell at loss, and that scenario repeat itself like other cycle top. And if you look at the SOPR, which is looking at if it's above 1, that means they're realizing profit. If a SOPR is below 1, that means that those investors are realizing a loss. And we specifically here showing the SOPR for different age cohorts of investors. And I just turned off all ages and we just zoomed on the 1 week, 1 week to 1 month, 1 month to 3 month. You could see the SOPR of the 1 month to 3 month is 85%. That means on aggregate, they're realizing a 15% loss. And they were the major sellers. You look at the absolute top buyers. So we can say with a great, confidence that the people who sold so far in loss were the people who were buying at like probably FOMOing. I'm not gonna say everyone FOMOed. Maybe someone really had a plan now, changed their mind. So most likely they FOMOed on top, and now they're realizing loss. They're realizing, oh, we might actually have a bear market, and they're spending at loss. If you look at the spending pattern for different size cohorts, you could see right after 105, the second top, almost all wallet sizes, whales and like the retail investors, relatively, they were cooling down their accumulation and they were leaning towards spending. So almost every single major cohorts of wallet sizes, they were spending. So not only they have 1 month to 3 month, but also different sellers from different size cohorts, different size investors, they were trying to cash out close to the top. So market was showing some sort of selling pressure coming into play, kind of like sentiment. And if you look at the accumulation score, which is literally looking at how much different different investors from different wallet sizes they're acting, they were all leaning towards spending as of accumulation behavior they were showing in the leg up back in November 2024. So all of them were screaming, hey, you are seeing some sort of overspending, overselling pressure, but no one could have like time it exactly. And all this together, Sina was showing, okay, market is showing some weakness. Now I want to use some metric. If you don't have a question or if you want to add anything, how can we use?
Just the previous chart excludes the exchange
Yes.
movements, right?
Oh yes, yes, it does.
Okay.
So now we established it was the short-term holder and almost short-term holder from all investor size classes like whales, retail, sharks. They have different names for them. And fishes, that's another name they have. So you could see that selling or de-risking was happening across all investor sizes, and also most specifically the 1 month to 3 month investors, recent top buyers. Now I think the question would be, where's the bottom? Well, right off the bat, I have to say no one can tell for sure what's the bottom. Like if anybody could say for sure what's the bottom, it can be a billionaire in a couple of months. So it's not 100% financial advice, but let's just use some tools and see if we can speculate what is the potential bottom, at least in midterm. The first chart that actually got a lot of traction recently, coined by Glassnode, is this chart. This chart is showing the supply, and it's categorized them or show them by the realized price or the cost basis. It shows how much Bitcoin, for example, at is it zoomed enough? I probably have to zoom a little bit more. Let me see if I can do this. Okay. Yeah. For example, it's showing how much coin was changed hand or was moved at 90,000, 89,000. So more coin moving at a specific price level, that means stronger that zone is going to be as a support or as a resistance if the price is below and trying to reach that level. So this is a great indication of supply distribution based on their cost basis. As you can see, back in November all the way to early December, the price moved so fast that not much coin got change hand in that price range between 70,000 to 88. This is what we call air gap. If you're looking at the Glassnode tweets or Checkmate and like on-chain analysts, they're using this term a lot. So this air gap means the price range that the price moved so fast or broke through so fast that the investors or people who were trying to buy or invest in Bitcoin or selling Bitcoin didn't get to spend much. And by air gap, we are not saying 100% we're gonna visit every single air gap, because I saw the CME gap. That's the term they use, the technical analysts. I'm not. We are not claiming this is going to be 100% every time you see some air gap. We're gonna revisit it. No, no. I can go back in 2000. Literally, let me see if I can go all
Yeah,
the way back.
people had this myth that all the CME gaps will close at some point, and I don't know. There was no basis for this,
Yeah, yeah,
and later it was clear that no, it, it doesn't have to happen all the time.
yeah. Like if you look at 2000. 15 2018, we had this air gap, we had this air gap, a small air gap here, we had these air gaps. So we had a lot of air gaps that price never ever got back to. So please, people, if you see a very nice tool, do not use it wrongfully. If you see one or two data point, do not make a rule for yourself. But I can say it differently. If we have an air gap and price get back to, so we are not predicting it's going to come back to that air gap 100%, but if it does, you could expect demands or people who were trying to buy that Bitcoin, you could expect them to enter the market and see some demand in this range. That's the best way I can put it in. And that's why in the 2 weeks ago and 3 weeks ago, I think, and last week, in almost all of them, I was talking about this air gap. I was not predicting we're going to get into it, but I was using the word if. If we get to this range, we might get some sort of support. And as I put it in the last week, 88 to 70,000, I suspect, and many other good on channelists, they're saying we might see some demand here. I mean, rightfully, like people try and buy here, price was moving so fast. Now they have the time to buy Bitcoins at some discount. I mean, psychologically, if we were saying price is going up, you might have been an investor say, hey, it's going up too fast. It's too expensive. I'm not going to buy. But right now, just put yourself in that person's shoes. Price is getting back to that range, and you already saw 105, 109, and you see, well, probably is a good time to buy. So psychologically, it makes sense to see some demand here. So that's the range I will be interested at, and I would watch in midterm. But that's not the only tool I would use.
What range was that specifically?
77,000 to 88.
Oh, okay. So during the whole gap, we expect buyers to show up.
Yes, like last time we went to 87 or 78, I think. No, sorry. What was the lowest? I have to look at the price actually.
78, 77.
Yes.
Yeah.
Yeah. So that's the midterm I would call, because remember I was joking last week. I said 70,000 is kidney level for me, because it's actually the lower band of this range, and if price gets there, I really have some kidney on the market to exchange with Bitcoin. I mean, and I was just joking, but I mean that is an extreme in midterm. If you get to 70,000, I would call it a very good undervalue point in the market for Bitcoin. But I'm not saying that's going to be end of it. No one can predict the bottom. But that's a very, very interesting range to watch if price keep chopping down. And the other metric that I really love, and I really think this model is going to be used a lot in long term, is true market mean. And Checkmate did a great job in the Coin Time article they did last year or 2 years ago. I don't remember the exact time explaining this. So I really encourage everyone to just look at the Coin Time article on Glassnode and understand what's true market mean. But to explain it, I mean, in a short sentence, is literally the cost basis of active investors, excluding miners. So you're looking at the, because realized price is the famous metric. Everyone watching the episode by 21st Capital or watching the on-chain videos, realized price is the cost basis of the market in whole, but true mean is the cost basis of the active investors. the people who bought Bitcoin in the second market, not the miners, and they are moving their coins in last couple of years. It's not being like it's not Satoshi coin being inactive for almost all history of Bitcoin. So this is more
Yeah,
realistic.
yeah. I mean, for example, I would personally, I'm just immune to the price movements, right? So whatever happens to price, my coins aren't moving. Um, and I'm just a very small participant. There is a lot of people, like you said, Satoshi coins that should be excluded. There
Yeah,
should be a lot of other long-term hodlers. They've seen so much volatility that they're kind of numb to the movements. But there is a subset, which is a huge subset of the market, that does react and
yeah,
does actively move their coins. And this metric is only trying to look at their cost basis.
yeah. And that number is showing 64. And it's a very interesting number. And if you look at this price model back in 2021 to 2020 to 22 market remained above this price very long time. And it was only thanks to Luna, FTX, and bunch of huge macro event that price plunged below this price model.
Can you
And
show
I'm
the
not,
longer history?
yes, let's go back 2015. Yeah, COVID. I think it was plus token hack. It
Mhm.
looks like market tend to stay above it until in a very low like point in the market when the liquidity actually is drained. A very low liquidity point. If a macro event happens, you could see that very strong capitulation in the market. But the majority of these cycles, bull market and post bull market, uh, I call it weak phase. I don't know how to name it, but right after the market top, still market tend to stay above it because it's the cost basis of the active investors. When price get closer to their cost basis, they lose the incentive to spend, and that is a very well articulated concept. But that doesn't guarantee the price is going to stay above. Like I said, Luna, FTX, plus token hack, COVID, and now Bybit happened right after the cycle top. Who knows? A World War III or a very big event might not happen and actually push the price lower. But even looking at the current market structure, we are way above 64. And that amazes me after Bybit, after that much sell off. Like, I think it was 3 weeks ago in our reports, we talked about how much Bitcoin was sold by long term holders. This is this is a chart that shows how fast the long term holders are spending in market tops. When you see these red big bars here, that means uh, this is showing you how fast the long-term holder, offloading the coin, they're cashing out. And we had two wave of long-term holders spending in this cycle. Pretty significant. Like it's actually comparable with 2020, 2021, or we had the 2017 sell-off. So we had two big sell-offs, and market was still above 100,000, and it was pretty amazing to me. Now we are crashing to 80, 78, but still up to 64. It is something that we saw in other bull markets. Market staying above, and we have to see, like, do we really get that sell-off, or similar to last year, which we had almost a year sideways market, we had that patient buyers that I keep referring to. That patient buyers step into market, waited. They have enough time. They were not in rush, but they bought at a specific price range, and I want to see if that plays out again. And using that 77 to 88 price range is what I would literally expect that demand face the sell-off. But hey, even 64 is not something that is unprecedented if you look at the previous data. And the other price model I think I showed a couple of times in our show is the short-term holders. This is the blue line, which was around at the time of crash, it was around 92,000. It broke below it, and like I said a couple of weeks ago, and this is a very significant threshold in the market as well. If price breaks below the short-term holder cost basis and is stabilized there, that is a strong indication of a bear market or a weakness in the market. But interestingly, in previous cycle, when we broke below the cost basis, we broke to one standard deviation below that cost basis and it stayed there for a couple of months. or in the bear market we had in 2020, we stayed for almost 2 years. But in March or April 2024, we broke below it. We had some shadow all the way to 107 below, but we were hovering around the short-term holder cost basis for a long time. So the bear market showed its time component instead of that price component. That is an indication of that patient buyers that I'm referring to. I'm not sure. Right now we broke below it and looks like we're stabilizing below 92. That's how it looks like if you look at it. But I don't know. Are we going to see another bear market, mostly the time component and the stretch bear market, or no? We're going to see another deep bear market like mid 2021 or late early 2022. That is yet to be seen. But if we see another sideways choppy or chop solidation, as a check put it, I would be like literally believing, okay, those patient buyers or ETF buyers or institutional buyers, long-term investor are literally are changing the behavior of the market for good.
Yeah,
Let's
this
see.
is this is one of the more bullish data points that I've seen.
Yeah.
Essentially, this is very like theoretically sound. That blue curve is showing the short-term holder cost basis, and it functions as an anchor where price mean reverts to it. I mean, a macro trend or some liquidity movement might move Bitcoin up or down, but
Mhm.
the shorter term volatility is always happening around the short term holder cost basis. Now, in other words, the price just doesn't stay for too long above or below that blue line. Right now, it's significantly below. So historically, historically, it doesn't have a lot of chances of going significantly lower. Maybe just a little bit lower, touching the line.
Yeah.
But we are significantly below the anchor, so there's much more likelihood of a bounce. So I
And
like what I'm
interestingly,
seeing.
yeah, interestingly, Sina, that one standard deviation, the yellow line is 71, like matching with that air gap we were discussing, 71, and that is why I'm really uh, looking at 71, and that true mean value was 64 and is rising, so
Mhm.
it looks like there is a strong support between 69 to 72, that range. But hey, tomorrow might something negative happen and all this equation, all this prediction and speculation just just go get wiped out from the face of earth. So I don't want to I want to emphasize, people, please do not use this and go long like 100x if price drop to 72. Just use this data to understand what's happening and make the right decision by looking at every single data that is in your disposal and you understand it. If you see this metric and you do not understand what does that mean, please just ignore it. There's a bunch of colorful lines. Just enjoy the graphics and don't act on these metrics. It's because you have to understand what is happening. Anyway, that's 71,000, which is the 1% deviation below the cost basis of short-term holder, or 70,000, which was literally the lower band of the air gap that you are hearing about recently. These are very interesting support level if price gets to. But hey, up to 64,000 is very well. Expected if you look at the previous bear market, because that's the true mean value in the market, true cost basis level in the market, considering the active investors. So far, what do you have any questions, Sina? I want to close up and talk about a little bit perpetual and cycle navigation.
Uh, I'll just add one thing. Just
Sure,
kind of another look at the realized price by age that you were
sure.
showing us. And this chart is basically showing the cost basis of the people who bought in the last 1 to 3 months, which is the orange, and then people who bought in the last 3 to 6 months. So kind of like both of them are short-term holders. One is like really short term. The other one is a little bit more longer term. Now, it's very interesting that the 1 to 3 month is a very important metric to look at. A lot of the bounces in a bull market happen right when we get to the cost basis of these people. Essentially, these are the most emotional, less experienced people. So their behavior and their psychology matters for the short-term price action. But for the more significant movements, more significant corrections happened when we reached the cost basis of 3 to 6 month people. So when we were coming out of the bear market, price jumped. Okay, we had a couple bounces at the 1 to 3 month age people, but when the cost basis of 3 to 6 months reached the price, that's provided a pretty good bouncing board, and we kind of moved up again. Same thing happened. The cost basis of these people caught up with the price. We bounced back up again, and now again, one more time, the cost basis of this group is meeting the price. So this is another good kind of base foundation below the price. And, in a short amount of time, this is going to move from 77,000 to maybe 80 and provide a first opportunity for the price to bounce back. And of course, as you said, the next level is 71. So DCA, man, DCA
all the way to whatever is the market low. I just want to close our talk with talking about the perpetual and futures market in general. Just look at Sina. Just look at this is the liquidation heat map, literally saying the open or the liquidation point of high leverage position open. When market was dropping below 90, just look how many long position got decimated. Like they literally were trying to catch the falling knife, and all of them got literally, I don't know, flushed out of the market. That was what happening all the way before last night. And then when we got close to 80 and sub 80, you could see in the strong liquidity level was formed below 80. So they were speculative markets. So that was, I think, one of the main reason we saw a little bit bounce back at 78. Even if you look at the open interest.
Wait a second. Yeah. Let's go back. Which one of these are actual liquidated values? Which one are not liquidated?
So let's zoom at last 1 week. Yeah, one thing I want to ask the CoinGlass people, please let us play with the price level and make it a little bit, stretch it around. Please, if you're hearing me. But hey, do you see these levels getting vanished as soon as price hit them?
So these are the ones that are liquid. They got liquidated. Got it.
Yeah.
Okay,
and you know what's funny?
Right now, what's not vanished is the liquidation level below 80, like between 75 and 80. Okay.
And it's funny, you could see people are shorting the market now, see? And the liquidation level is around 90. And it is so fascinating how people having enough money to
let's say price goes back up to 90.
Yes.
And these guys will get crushed. So there would be a huge magnet because of the short people getting squeezed.
Yeah.
And then there is another one at 95, another one at 100. So there's some rocket fuel on both sides.
Yeah. So let's see who's wrong. I think from my perspective, both of them are wrong. But yes, one of the reasons I think price saw some bounce back around 70 something, 78, 79. It was just, you could see the perpetual seeing a very huge demand. And if you look at the futures market, OI, which is a combination of perpetual and calendar futures market, you could see a bounce back when market was going up. You could see the demand was there. And when you put it next to funding rate, you could see Bitfinex, the funding rate actually becoming super positive. So there was some demand to buy the dip or long the dip, I would say, probably that's the right term. But across all other major perpetual, you could see the funding rate didn't get to the negative territory, but they stayed close to neutral. It was the, I think, it was the Bitfinex and BitMEX. You could see there's a really large, compared to other exchanges, you could see they're trying to long the market when the market was crashing, and that was one of the reasons that market was actually seeing some sort of like bounce back. But something interesting I noticed this morning, if you look at the open interest of CME, because in general the open interest of futures market was dropping, and that is general. It's the BTC term, it's not the dollar term. Because if you look at the dollar term, the reduction in OI is mostly due to the price dropping and the value of the contracts are dropping, obviously. But if you look at the BTC term, you're excluding the price effect, and you literally look at the number of contract open or closed. Since 109, you could see the open interest in futures market was dropping. That is a sign for diminishing demand for speculating the market or being speculative. So that is a early sign of demand just being dried out or demand leaving the market. But when you look at the CME, that's the major reason this open interest in general is dropping. So from 109, you could see, because CME, when you look at their uh, open interest and the change in open interest, we wrote a couple of articles on this, and we were showing some evidence that most of CME open position is a part of another strategy, neutral strategy. They're long in the spot market, short in CME, and they try to monetize the bullishness in the market, monetize people who are willing to pay the premium or funding rate to be long in the market. As you could see from 109, the CME open interest was dropping. That was another sign that even those neutral traders are not seeing much demand for long side. They're not seeing people willing to pay much funding rate to just be long in the market. And that was interesting to me. And look at the funding rate. It was dropping from 109. So these are all were early signs one could have used to say, okay, demand is leaving the market. And we explored those metrics in the Beacon chain call falling trades or thinking ahead. I think it was this. Oh no, yeah, falling tides. Yeah, it was here. Falling rates here. So if you put all these early signs together after 109, at least the futures market was showing, okay, there is some sort of lack of interest in long in the market. But the like I explained, the Bybit was the last nail in this coffin. Let's see if markets see enough demand to bounce back. But personally, I want to get to this point. Personally, I'm interested or I'm hoping to see some sideway. I mean, enough time for people to uh, change their Bitcoin. People who are scared, who people who have not much conviction and just spend their Bitcoin, and the long-term investor jump in, those patient buyers jump in and create a base for next move. God knows when, next year, tomorrow, next month. That is what I really like the scenario to play out.
Yeah, yeah. It's possible that, I mean, in many cases, the crashes like this, a 30% crash, it destroys sentiment so strongly that people would not quickly buy it, and it needs some time for all the damage to be absorbed and recovered. And essentially what we will see, as we actually, our analysis today shows, a lot of the short-term buyers, just people who bought in the 90 to 100 range, those are the people who have been caught off guard and are selling. People who bought last year are not. The ones that bought last year and they were paper hands, they have already sold in one of the moves, ups or down. So, but not anymore. Right now, it's mostly the top buyers. Once those top buyers are exhausted, and that takes some time, we will see the market finding a bottom, and slowly the panic effect goes away, and then we are left with the positive effect of adoption, because there's always that adoption trend that's on a long enough time frame moves Bitcoin upward. Well, fundamentally speaking, everything is fantastic for Bitcoin. The regulatory landscape is extremely positive. A lot of investors, like I said, are now contemplating buying Bitcoin. And as Wizard was expertly mentioning, smart buyers, when price jumps from 60 to 109, they don't FOMO buy, right? They actually take a step back. They will give it some time, and they're most of the time they're right. Price does make a correction afterwards. Then once it has corrected enough, where people think, okay, this is now a nice price, they'll come back in and begin allocating the funds that they couldn't allocate previously. Especially in the last couple of years, the investor base have improved a lot. Previously, investor base was like a 5% die-hard hodlers that just love Bitcoin, and they would ride it down to zero, and they would never sell. But unfortunately, 95% of the market were gamblers and traders. So these people, by definition, are active sellers and active buyers, and they react to price movements. But now these people have been eclipsed by the institutional buyers. Institutions are typically much more longer term allocators, and they don't care too much about short term volatility. They actually buy more when prices is low and take profits when prices are high. So structurally, it's very, very positive and beneficial for Bitcoin. What we are seeing, everything is just accelerating. Adoption on many levels at the individual, institutional, sovereign, and corporate levels is expanding. And we simply need to give it some time so the trade war effect is removed, and also the price damage, the psychological damage that has been imposed on the top buyers, also that one gets absorbed. When both of these things happen, we'll resume our move towards making Bitcoin the foundation of the global monetary network. Again, one of the best things you can do to benefit from corrections like this is to establish a DCA plan, ensure that you understand Bitcoin. If you don't understand it, don't buy it. But first, make sure you understand it. You know the fundamental case. You know the long-term view. And if that convinces you, if you're convicted enough on the long-term perspective, these corrections are some of the best opportunities that you can find. And Bitcoin gives opportunities to people that deserve it, but also takes the coins away from people who just want to get rich quick, who sadly typically always show up at the tops. Well, don't be one of those. And this is a garden variety movement that we're all used to in Bitcoin. Thanks a lot, Zi. Fantastic analysis.
My pleasure.
Any other point?
No, you said it very well. I hope everyone use this data into their benefit, and I think the best thing you can learn from this data is to act wisely. I'm not saying don't sell or buy the dip. I'm not a fan of telling people what to do, because it's very, very different from me to someone else. But when you have access to this type of data, I mean, based on my personal experience, you act more based on data rather than emotions. That's, I think, what we're trying to fix here, to just take emotion away, see what's happening. Most of the time, if you see what's happening behind the scene, you would act better. That's the end goal here. And I'm glad that Sina, me and you have you make me, actually, because I'm a lazy person, every week at the same time, and I prepare some chart. I'm really, really happy for a couple of people, or 100 people, or 1,000 people. I don't really care about the number. Are waiting for us every Friday. So I encourage everyone to look at the new platform Sina is working on. I really believe in this kind of movements. Have free access to data. If people have access to data, they're going to act better. And Bitcoin on-chain data is what I'm going to help Sina to develop a little bit further. I encourage everyone to stay tuned, and let's see what we can do.
Yeah, fantastic. Thanks a lot. We are, again, I've said it several times, we are very lucky to have you. Essentially, you're allowing the audience to access the top-notch reports that Glassnode is putting out for paid subscribers and institutions. You're giving us access to all that knowledge. Very grateful for that. And I hope that we can do more in the coming weeks as we launch our platform as well, and bring more content and actionable insight for the audience. Also, thanks to the audience, we've had almost 2,000 views so far, 1,800. Pretty good number historically. Thanks a lot for being with us. Appreciate your comments and support in different platforms. Definitely keep your thoughts and comments coming. We pay attention to all of them, and it kind of acts as a engine fuel for motivating us to do more. With that, I appreciate everyone's attention and these insights that he shared with us today. And we will see you guys next week.
See you guys. Have a good weekend.